introduce Tim. Tim and I worked together years ago on a company called Royalty, which was before that. Within 3 months of presenting him in New York, the stock was up 3 times. In less than a year, it was up 5 times. And within 2 years, it was up 10 times. We like gold royalty companies because they have limited downside and participate in most of the upside of the gold market. Obviously, if a gold company hits a bonanza gold situation, you can get it 10 times in one day. But in general, royalty plays are one of the safest ways to play gold if you're a conservative investor, and you make your most money, and I'm stealing a little of his thunder, in the first 3 years. Tim has done it before. I'm a believer in Tim. I'm a believer in the concept, and I believe Tim's going to do it again. So please pay a lot of attention to this presentation and certainly put it on your screen. And I think if you're an investor, you're going to be happy.
So welcome, everyone. We have a new vehicle to go after another set of precious metals royalties. And Xtierra is a vehicle that I helped take public over a decade ago, and it still has the 2 Mexican assets in it. And we've been slowly working towards the timing of a new royalty portfolio focused on cash flowing gold and silver royalties. And that obviously ties into the phenomenal outlook for gold and silver, the extra leverage from silver. But the more important point is we learned, going back 4 years ago, that the way the market seems to value when we simplify the royalty business by virtue of the payout. At least that's our focus. It's a financial product that is uncorrelated, and if you can pay a monthly dividend, it will get valued at 1% or less. In the extreme, when you get to the peer group, you'll see that the multiples from a PE perspective seem outrageous, always over 100 in cash flow. So what we concluded was that really it came down to the comparison points around the world are essentially 1%, 1 or 2%. When we started back in 2016, we were thinking that we could trade at repricing of 5 or 6%. And as soon as Metallo was able to pay a monthly dividend, it totally changed the investor base and ultimately the sub 1% valuation. So specifically, we think we're a very timely low price investor opportunity. And as Henry said, the key ingredient is to get in at the beginning. If you already understand the royalty model, then just let the team add the assets and grow it according to that valuation. So in terms of the historic vehicle, we've got these 2 feasibility stage studies in Zacatecas, Mexico. We're simply trying to add gold and silver royalties. They're never completely pure plays. There's always some other metals, copper and so on. And if we started in the spring, I wouldn't have said that the Bilbao asset that we have historically had any value. It was written off because the assumption in the PEA we did included the assumption of $30 silver. And of course, silver was at $15 for the better part of the last 7 years. So it was written off. But, as silver jumped to basically $27 of late, then all of a sudden that asset and the leverage to silver looks interesting. As far as the vehicle goes, we've got our royalty-focused shareholders that own the bulk of the vehicle. Historically, Buckins, which is a private company, has 30 million shares, which is about 18%. So even though we have 162 million shares outstanding, we're actually quite tight. So 2 strategies, basically accumulate precious metals royalties that are cash flowing in order to pay out monthly dividends. And then the second thing is to maximize the value in a rising silver environment on our Bilbao asset in particular. So going back to the basics, because I still find that most investors really don't appreciate the royalty model in terms of its elegance and really the genius of the way these events have converged to create this maximum valuation based on cash flow and payouts. So in terms of the key ingredient, it clearly doesn't have any of the risks that a direct investment has from the point of view of a specific asset, a specific location. doesn't have essentially any expenses, mostly run by, in my mind, a couple of people at each of the entities, and whether you hire more people because you can afford to do due diligence on new deals rather than doing them off payroll is a different story. But the bottom line is it's an asset management business, and the royalties themselves are non-dilutable, as you know. The key point about the 100% margin, and maybe that's for me the most important point, is you're getting a piece of the top line, and if you invest and collect, it's 100% margin. It's a pure cash flow, and we're valuing a pure cash flow in a zero interest rate environment, which creates, what seems to be these very high valuations, but it just fits into the global peer group of what we're summarizing as 1%. So it's low risk for a number of reasons: the lack of overhead, the ability to diversify by multiple operators, commodities, and countries. You've got that upside from other parts of the deposits, and I think the most important point for me in terms of my epiphany in terms of this business, it's really like the asset management business in general. You're just growing a portfolio. You don't start at zero like a normal business, with sales. It's an annuity business. It's an assets under administration business. So, why does it really stand out and why we want to do another one? We've arrived at a place after a good 20 years that every asset class is basically peaked. Adding in the pandemic, real estate doesn't look like it used to. Banks have peaked in terms of their growth. They may have write-offs, after these deferrals. Bank stocks have huge valuations, the globalization story, global corporates, and obviously bonds at, 0.5% or less. So, where do you go? When you compare it to having money in a bank account, tied to paper money in any currency, you're really losing value, and essentially you're making nothing after returns, after inflation. So this simple model where you're targeting cash flowing royalties, even one that pays $1 million at 1% creates 100 million market cap, and that's really the incremental leverage from making the conversion and the focus to doing a royalty company. So I can't emphasize this more. It's not about being in the business. You don't want to be in the mining business. You just want to attach yourself to an already proven deposit, and especially the ones that are already cash flowing, and just get a piece of that top line. So, when we're going down the model, we're basically saying if we just get or aggregate a simple $1 million in cash flow that gets paid out because there's no overhead, we will drive 100 million market cap at 1%. So 2 million takes us to 200 million, 3 million takes us to 300 million, of course, 10 million, $1 billion. So the leverage to extraordinary returns, is extremely attractive, especially in a world where it's hard to find any growth anywhere. And when we apply this, as you'll see later, when you relook at the peer group from this dividend valuation only, you'll see it's proven up. In fact, they trade arguably at the 0.6, 0.7% yield. So, oops, I hit the wrong one. Oh. First page down. So, as far as the peer group goes, you can see for 35 years worth of history and the brand in Nevada, hang on one sec, yeah. You've got this extraordinary story that started off as a shell, 2 million market cap back in the mid-'80s, and it's growing to basically 30 billion US, or 40 billion Canadian. So there's no stock that I know of that's ever achieved those kinds of returns. And if you went name by name in terms of the history, all of these companies have done the same thing from a standing start, which is truly phenomenal for these tiny teams. And if you pay attention to the dividend yields, that's the point. So, even Wheaton here for 25 billion market cap, the cash flow and a portion of that paid out as dividends, that's the focus. My former company, Metalla, from a standing start, reached almost $500 million market cap in 4 short years, same dividend yield. Maverick, same thing, amazing market cap, almost $1 billion. And Ellie, more recently over the last year, from basically 15 cents to as high as $2. So we're down at 32 million market cap with, if you believe, which happens to be the amount of money we spent on the original Bilbao deposit. So if you believe that we can actually get that value in this cycle with rising silver prices, with a little bit of work even to extend it, then you're getting the entire royalty strategy and portfolio for free. So again, just to remind you of the way we look at things, you've got Franco-Nevada with 190 million shares outstanding, basically paying out $1 in dividends and trading at a 30 billion market cap. So after 30 years, the key metric for us over here on the far right is how many paying royalties have you got? Because that's essentially how you're being valued, and all the other potential royalties are development projects with a lot more risk, and a lot of mistakes have been made, or the only mistakes that have been made in the royalty business have been backing things that, for one reason or another, end up not going into production. So if we can focus on the producing situations, then even one paying royalty, which was the experience with Metalla and the pro forma potential of Ellie, gives you an astounding market cap from a standing start. So again, from a financial product perspective, we're just trying to revalue a targeted $100,000 per month, because I think it's important that you pay out monthly dividends. So if we can use this as an example and the logic of targeting a 10% yield. So if you could buy $1.2 million in cash flow for 10 times, obviously we're trying to do better than that, 5 times is our target, but, and you kept it private, then obviously it's still worth the 10% yield. But as the story gets told, as you market this into the peer group, as you make the comparisons to other assets in the public market when REITs were up higher, and people start to see that you're growing the dividends, then you can approach this targeted 1% yield, and from that $12 million investment, get to $120 million in market cap. And again, we're looking at the whole world, whether you're talking about the average corporate yields, the average bank account payouts, GICs in every country, this reduction of the interest rate is the key valuation metric. So what can go wrong? Obviously, over time, we think rates will bounce up at some point. And obviously, the underlying business is a volatile industry, and of course, oil and gas royalties haven't benefited the same way that a gold royalty might. So that's why they're not nearly as exciting. As far as what we've got to date, in terms of the progression to a royalty portfolio, we've got this asset that we spent $30 million on that's got a PEA from RPM from 2014. A separate owner had the 1.5% royalty on that asset. We bought that back over the last year, and through that connection, we got to know this owner, Minera Portree, and learned of the 6 claims that it had a royalty on 2% of a local mine, a copper-silver mine called Cozamin, owned by Capstone. Now that's needs to be legally perfected, but this is just one of many ideas we're working on in terms of adding cash flowing royalties to the portfolio. As far as a main area of potential valuation and return in the current market, it all comes down to your outlook on silver. So if you believe it can break through the old highs of $50 from 2011, then the stock reward will be commensurate. But one thing that's interesting about the peer group is it really hasn't changed a whole lot. And again, you've got these large market caps of the peer group that have been around for a while. And if we could figure out a way to sell our Bilbao asset and convert it into a cash flowing silver royalty from one of these companies, then that's one of our ideas for creating value, as well as obviously getting the return on capital. This asset's in the prolific historic silver belt of Mexico. Zacatecas is the state. Neighboring mines besides the Cozamin one would be two mines that were owned by Carlos Slim entity, Minera Frisco. Fresno's in that area. Across the road, the former Aryan silver. So it's got the 500-year history of Mexico and silver assets. The key thing for us that when we reviewed the old data and the old press releases from our drilling campaigns in 2010 to 2013 were these high-grade results outside the main feasibility study, and we were focused on getting that, PEA actually, and the infill drilling. But we've done some work outside, and there's this vein as an example. X26 is the best hole where we had 2 kilo material. You can see some of the wider intercepts, including some gold. And so when you look at the potential of even adding a small amount of tonnage at much higher prices, as I'll show you, the average for this, by the way, was roughly $100 per ton metal. As a reminder of the good jurisdictions of really Nevada all the way down into Mexico, it's not an area that's in the jungle or in the Canadian North, so it's very amenable to mining. Here's some more examples of another drilling campaign showing this higher grade material, 10 to 15 ounce silver, and when it comes down to the main deposit is here with the 3 glory holes. This high-grade vein is only one of 6 targets outside the main deposit, which has got us excited about the potential extra value we can add. And clearly, if I take this sort of 500 meters here, and I did a little quick calculation just to show you how even a small 2 meter vein at 300 meters depth can give you an extra 750,000 tons, and with higher silver prices, with that 15-ounce material or 450 gram material at $40, you've got an extra 450. So we think that's the thesis as far as doubling or tripling the potential value in the area. Our team goes way back, and from the point of view of the value add, we get a lot of ideas from our shareholders who've made money with us, in the business, in the royalty business, and totally understand the model. So that's what we're targeting. I hope that covers it in quick order. Henry, back to you.
Okay, let me take some questions, and I'll also take some questions, but I also want to, 2 things. First, to do questions, you can either put it in chat and type it, or you can put reactions and then show your hand up. The other thing is this, I forgot to mention one other point about royalties. When markets were really rallying in 2010 and 11 in the gold space, everybody was making money. When they went down, gold royalty companies were one of the few that still made money and outperformed. So even though the actual sectors was not so strong, so there's basically a defensive element too, that if for some reason 3 years from now gold is not as hot as it is, a gold royalty company still makes money, and in general the companies make money when they're doing well, if they're well run. So it's a very interesting model to look at. So I'm going to open